Let's take a look at some boundary conditions for options. Before the Black-Scholes and the binomial option pricing models were formulated, a set of boundary conditions was used to provide minimum and maximum values for the option. And these conditions are based on the principle of arbitrage. That is, that you can't make a riskless profit using no funds at all. And the way you would do that is you would create two portfolios that had identical payouts, and if they had identical payouts, they should sell for identical prices. If they don't, then someone's going to buy the cheap one and sell the expensive one, and they're going to drive the price of the cheap one up and drive the price of the expensive one down until the prices are correct again. All right, here's some notation. I'm going to use lowercase letters to signify the values of European style options. Those are options that can only be exercised on the last day before the option expires. I'm going to use uppercase letters to signify the value of American style options. These are options that can be exercised anytime up till the option expires. So C will be for, an uppercase C will be for an American call, lowercase c will be for a European call, lowercase p will be for a European put, and I'll put subscripts sometimes to indicate at what time we're looking at the value. Here we're looking at the value at time 0. X is the exercise price, S is the stock price, so S sub 0 is the stock price at time 0. R is the risk-free rate. T is the duration of the option, or when it, how long it takes until the option expires. And D is the dividend, if any is paid. Now, the minimum value of any option, European or American style, put or call, has to always be greater than 0. Okay, no less than 0. Let me say it that way, because you can always allow the option to expire worthless. So if you think you're going to lose money on it, you just throw the option away. You'll lose what you paid for the option, but no more. The maximum value for a call is that it can never sell for more than the underlying asset. So if you buy a call option, that gives you the right to purchase the shares of stock at the exercise price, and clearly it makes sense that it can never be worth more than the stock itself. And this would be true for both a European and an American style call. For a put option, for a European put, it's going to be equal to the present value of the exercise price. The exercise price is the price you can sell for, and if you think about it, the worst that can happen to the price of the stock it goes to 0. But with a put option, you can't exercise right away. You have to wait. So the present value of the exercise price is the maximum value for a European style put. For an American style put, you can exercise right away. So if the stock value went to 0, then the option could be worth as much as X. Okay, it can never be worth more than X. So here's a table that summarizes these conditions, and also some numbers here so we can see what it looks like. For the European call, the price has to lie between 0 and $52 because the stock price is 52, the exercise price is 50, the risk-free rate is 5%, and the option expires in half a year. Also true of the American call, has to lie between 0 and 52. For the European put, it has to lie between 0 and the present value of the exercise price, which is $48.80. And for the American put, it has to lie between 0 and the exercise price, which is 50. Now these are pretty big bounds, so this isn't particularly valuable. So let's move on and see if we can't narrow these ranges down a little bit more. The lower bound on options, okay, in the case of an American style option, it can be exercised immediately, so the lower bound is the current intrinsic value. And this is true for both a put and a call. the intrinsic value for a call option is going to be either 0 or the price of the stock minus the exercise price. If the price of the stock is above the exercise price, then the option is in the money, and so this would be the value, the maximum value that the call could take on. Okay, I'm sorry. The call has to be at least this amount. If this is negative, the call is out of the money, then it would take on a value of 0. For a put option, you have the right to sell at the exercise price. So if the sell price, the exercise price, is greater than the stock price, the option is in the money, and then the option would be worth at least this much. If this is negative, so that the stock price is greater than the exercise price and the option really doesn't have any value, then it takes on a value of 0. In the case of a European style call option, you can't exercise right away, so we need to sort of work out what the value of the call would be. And we do that by creating a portfolio that includes buying the call, selling short the stock, and buying a bond with exercise price of X. And then we look at the payouts in different situations where the call is in the money, out of the money, at the money, etc. Now, I'm not going to do that here, but the conditions tell us that the European call has to be greater than or equal to the maximum of 0. Okay, again, these can never be less than 0, or the stock price minus the present value of the exercise price. Similarly, for the put option, the European put, it has to be greater than the maximum of 0, again, can never be worth less than 0, or the present value of the exercise price minus the stock price. Remember, this is the price you're selling at. Now, if there are no dividends being paid, then the American and the European calls are equivalent. And the reason for this is because no one's going to exercise an American call option early if no dividends are being paid. You can always sell the option for more. The option will have some time value. And if you haven't watched it, I have a video on time value and intrinsic value for options. If a dividend is paid, then for the European call, it's going to be the maximum of 0 again, and then this time, instead of just the stock price minus the present value of the exercise price, this is just continuous time present value. I'm not sure why I switched from discrete time to continuous time, but this is the same as the continuous time version of x divided by 1 plus r raised to the tth power. Okay, minus the dividend. And the reason that we subtract out the dividend, if the stock pays a dividend, when it goes ex-dividend, the stock price will fall. And that will make the option worth less than it was prior to the ex-dividend date. And it's the case that stock options are not protected against cash dividends. They are protected against stock splits, but not cash dividends. So if you know the company has declared a dividend, you may want to exercise early. If it's in the case of a European American style option, in the case of a European, you can't exercise early. In the case of a European put option, when dividends are present, this is the case where it's got to be the maximum of 0, or the present value of the exercise price minus the stock price, but plus the dividend. The dividend is good here because the dividend lowers the price of the stock, and that makes the put option worth even more. So high dividends make a put actually more attractive. Let's take a look at some conditions here where we have two call options, but they have different exercise prices. All right. it's going to be the case that if we have two exercise prices, X1 and X2, where X2 is greater than X1. So let's say X1 is $50 for the exercise price, X2 is $55. Then it's going to be the case that the option, whether it's European or American, with the lower exercise price is going to be worth more than the one with the higher exercise price. And this makes sense because the exercise price is the price that we would buy the stock for, and it's always going to be better to be able to buy at 50 than it is to buy at 52. That's going to make the option with the lower exercise price more valuable. There's also a condition here that shows us what the difference between the two should be if these are European calls. And the difference between these two, this is going to be the higher price call, and here I have a subscript T, T signifying that it expires in T periods, or at period T, okay, minus the second option, which expires at the same time, and it's got to be, the difference has to be less than the present value of the difference of these two exercise prices. Okay, this is also the same condition we get when we look at American style call options. Okay, that the difference between the value of the two options with different exercise prices has to be less than or equal to the present value of the difference of the exercise prices. Now, what about for put options? Keep in mind that this exercise price is the price we're selling at, so a higher exercise price is going to be better. And it's going to be the case in both the European and the American put. So it's going to be better to be able to sell at 55 than it is to be able to sell at 50. That makes this option more valuable than this one. Okay, here we have the same sort of conditions we had before, that the difference in the value of the puts with the different exercise prices should be less than or equal to the present value of the difference of the exercise prices. Okay, again, if this isn't the case, there's an arbitrage opportunity. That is, you'll be able to make money without using any of your own money. Okay, and you'll be guaranteed that return. In the case of it being American puts, because you can exercise immediately, the difference between the two should be less than or equal to the difference in the exercise prices. All right, let's finally talk about time till the option expires. In the case of a call option, the more time there is until the option expires, the better, whether you're talking about a European or an American style call option. Okay, here T1 is less than T2, so this might expire in 3 months and this expires in 6 months. It's going to be better to have an option that expires in 6 months than it is one that expires in 3 months, so that's going to be a more valuable option. It's going to be worth more. Okay, for put options, it depends. It depends on whether these are American or European style puts. In the case of the American put, the greater the time to maturity, the greater the value of the put. Okay, which is what we would intuitively expect, because there's more time for the option for the price of the stock to go down, so there's more time for you to, so people will pay for that. Okay. In the case of the European style put, it depends. Okay, the one with the longer expiration could be greater or it could be less than the one with the shorter expiration. Now that seems a little counterintuitive because the longer the time to expiration, the greater the chance that the stock price will move in a favorable direction, in this case going down. But we have to keep in mind that when the put is exercised, the holder of the put receives money. and the lost interest is a disadvantage of the additional time. So the longer you have to wait to get your money can be a disadvantage. And again, in the case of the European put, you cannot exercise until the option expires. So these are some basic conditions on some basic boundary conditions on puts and calls, and if they fall out of those lines, then there's going to be an arbitrage opportunity. So without even knowing the Black-Scholes or the binomial option pricing model or some other option pricing model, you should know that option prices should fall within some sort of basic range or some basic boundary.